Hey guys, my name's Ravi Sharma and thank you so much for joining me on another episode of Search Property TV. I'm the founder and buyer's agent at Search Property. Now guys, today's video is about what interest rates look like currently and what they will look like in the next 3 to 5 years. This is purely my prediction, and of course, as all of my videos are, they're purely for entertainment purposes. And if you do require individual advice, financial advice, then please do contact us and we can point you in the right direction. But guys, this is a super interesting topic. I get asked pretty much on the daily, at least 2 to 3 times a day, where people are messaging me and saying, hey, look, it's all great. We're in, an environment where at the moment our cash rate is 0.25, but what happens if I purchase property and the rates go up? Next year or the year after, then I'm really going to be struggling. And this is where I need you guys to understand and be patient with this video, because I want to give you some context about why interest rates move up and why they move down. And at the end of this video, I'm going to show you what my predictions look like for the rest of the year as well as following forward. Now guys, it's important to understand what interest rates exactly are. So interest rates are effectively determined by the Reserve Bank of Australia, so our central bank, and it's use of monetary policy. So there's 2 ways the government can sort of, push the levers to either make, things happen like economic growth or really slow things down. So that's the fiscal policy and the monetary policy. In a nutshell, the Reserve Bank operates the monetary policy, and they usually do this by cutting rates or increasing rates. And then we've got the fiscal policy, which is then determined by, what the government spends. So that's where the budget deficit and budget surplus comes into play. A lot of the stimulus that is getting, given out at the moment, that's the fiscal side of things. However, there is a connection between the two, and they both operate in a very complex way, and is for definitely another video. But to keep on track, interest rates are really about trying to pull the lever back and forth in terms of a desired outcome. Now, currently we're dealing with the effects of COVID. Now, things are slowly opening up. The economy for Australia is not as in bad shape as they first predicted. Media headlines saying that possibly 150,000 people will die in Australia. Clearly that's not the case, right? And the media loves to have a bit of a yarn and write some negative headlines because that gets the viewers, right? But what essentially we're at is at 0.25, that's our cash rate. Now, we have actually seen now almost 10 years, if not a little bit more, of never seeing an interest rate hike. So what I mean by that is I'm going to put up a graph right now. It's from Trading Economics, and you can clearly see that there hasn't been a rate increase in the Australian economy since 2010. Now, we all see a big decline around that 2008 period, and that is when the global financial crisis happened. It's pretty much why we avoided having a recession in Australia. Now, currently in 2020, June, I'm recording this, we've just recorded our first quarter of negative growth. We're definitely going to be in another negative quarter of growth coming into the next quarter because of COVID and the effects of shutting down the economy. So we're definitely going into a recession in Australia. So that means look at 2008. This graph is showing us that we tried to reduce our interest rates to really drive economic activity. The reason we do that is so that there's more economic activity, economic growth and stimulus within our economy, so that we can get back up to fighting level, get back up to those inflation targets that the Reserve Bank has. Now, the Reserve Bank has an inflation target, right? So of 2 to 3%. Okay, now 2 to 3% inflation is a healthy economy. At the moment, we're at about 2.2. Now, that doesn't really take into effect of what's exactly happened. So again, take that with a grain of salt. Now, Phillip Lowe from the Reserve Bank of Australia has noted that in the last meeting that we may not see negative interest rates. And that seems to be the buzz at the moment. What is negative interest rates? Are we going to have them in Australia? Is that something that is, just absurd? Now, 6 months ago, people were saying, it is absurd. People 6 months ago were telling me that interest rates may go up. And that's purely a lack of understanding of how the wider economy works. This is why I keep referring to the fact that the pandemic was merely a pin in the bubble that the financial system presents. It was due to collapse in 2020, regardless of if COVID happened or not. So I was looking at 6 to 12 months ago where 2020, we were definitely gonna have that collapse, and now we're seeing it come to fruition. So what happens in this environment is we're in a deflationary period. Now, Phillip Lowe himself, along with chief economist from Westpac, Bill Evans, has said that we cannot increase interest rates, or the cash rate, we cannot increase it for at least the next 3 years. Now, my prediction on this front is that we are never going to see an interest rate rise unless there is only one situation we will see interest rates rise in the next 5 years. And that is going to benefit anyone that has assets attached to debt. That scenario is hyperinflation. Now guys, look at what happened in Zimbabwe, Venezuela, and a few other countries like Germany back in, I think it was about World War II time. Look at what's happened during these periods. Now, effectively, it's a very rare chance it may happen, right? According to some economists. I think we're definitely heading down that way, especially with how much money is being printed, quantitative easing, a lot of manipulation of the market. But keeping on track, as we like to do, where are we headed towards the end of this year? Now, a lot of these economists are coming out and saying we definitely aren't cutting, but we may increase. Now, in no scenario are we able to increase. Our unemployment rates are so high due to COVID. We need to get that back into target range, right? We need to get this target happening as well, because a growing economy at about 2 to 3% is healthy. So here we go. By 2021, so by the end of this year, we will see 0%. Okay? So we're going to track along and we're going to drop. Now, I was predicting initially probably about September, October is when that cut will come. Now, effectively, because our cash rate is 0.25, it'll go down to 0. That doesn't necessarily mean banks will pass them on. But at the same time, we've also seen some banks actually cut fixed rates and variable interest rates in the last few weeks. And that's purely because the RBA in the background, they're pulling up other levers, right? So for us, we're looking at media headlines maybe, and we go, oh, well, they didn't cut the rates again. Maybe we're headed the other way. Don't know. But in the back, they're actually buying up bonds. And so the real rate is not 0.25. It's actually about 0.12. So that's how banks were able to pass on some cuts in the background. But we are definitely headed to 0 by the end of this year. And from there, I think we will see the first negative interest rate about here, and that will be minus 0.25. And then by 2023, I think we will see anywhere from 1 to 2% negative. Now, what does this exactly mean? Okay, so negative interest rates. It's the opposite of what interest rates are. So interest rates are basically the cost of borrowing. So the banks, they borrow, and they can borrow at a certain cash rate, and then they pass that on to consumers with interest rates. So at the moment, you can get an interest rate of about 2.2%, okay? Home loan rate. Home loan, okay. So if that's where we are and that's the cash rate, what happens when we get into this territory? Now, if you want some more information about how this actually works without trying to complicate this video, it's called modern monetary theory. I'll leave a link in the description below of another YouTuber that's created this video, and it makes it very simple, and I'll link you to an article or two. It makes it very simple to understand. If you still do not understand it, then please give me a call. Let's have a chat, email me as well, and we can go through this. But effectively, if we're gonna go from here to this number, this rate that people can get mortgages on will drop, okay? How far we will drop? I think we will see interest rates of about 1% to 1.5%. That's where I think the maximum we are going to see in terms of the lowest it can be. Now, some people are going, well, if we do go down this path and we get negative interest rates, does that mean technically the bank will pay us to take out a loan? Yes, they will. There are banks actually across the world. I'm going to put up a few articles here of banks, countries in these banks, banks in these countries that are actually offering negative interest rate home loans. It's absurd when you think about it. It's an upside down world, but that's where we're headed. Now, people often say, well, that may be the truth in the first couple of years, or maybe it's the first 2 years. What happens after that? Are they going to go from like -2 to like up to like, 7%, and then I'm screwed, and then property's screwed, and everything's gone? Guys, this scenario is only possible in one situation, and that one situation is hyperinflation. Okay, so if you are looking at purchasing property, and if you find yourself on this channel, you probably are, the scenario of 7% or above that in a hyperinflation situation is the best thing for a property investor. Now, I may get a lot of hate for this, but stick with me. If inflation occurs within our market, everything goes up in price. So now we've established what my predictions are. Let's just wipe this off. And I want to tell you what hyperinflation in a nutshell will look like. So we've got all this money that's been, printed out, JobKeeper, JobSeeker. Yes, everyone's happy. The housing grants come in, a bunch of other grants have come in, and they'll continue giving us more stimulus, try and keep this market propped up, right? What we're going to see is inflation kicks in. So hyperinflation. Hopefully hyperinflation fixes my handwriting. Hyperinflation occurs. So at the moment, you may have debt of say 100K. 100K debt. Okay. But you're earning an average salary. The average salary is $50,000 per year, per annum. Okay. So when inflation occurs and everything becomes expensive, or everything rises in price, so wages go up. So wages will go up, rents will go up, cost of goods go up, okay? So all these things start going up. So now the average, right? And the best way to explain this is 10 years ago, the average income or wage earned in Australia was not $50,000, it was a lot less. And so were, the price of paddle pops, the price of rice, the price of, pasta sauce. They were all significantly less than what they were, than they are now. So this salary then happens to go up to, say, 100K. But everything else will move in line with it. So if now you're earning 100K, paddle pops may go from $1 to $3, right? So everything else will also move up in price. This also leads to why house prices and asset prices go up. Everyone keeps going, oh, there's a bubble, there's a bubble. They clearly don't know what they're talking about, because it's not so much the affordability of housing, it's actually the money being devalued. Because there's more money in the system, right? And they're pulling all those levers in the background, that's what's causing asset price inflation. So you now earn 100K, and everything else in terms of cost of goods, rents, they all move accordingly. So they're all going to go up by a certain percentage, some more than others. But one thing that does not move is your level of debt. So the debt is not going to go up with inflation. It's just going to stick there, right? And if you were paying principal and interest, you'd be paying down that principal. But if you're just paying interest only, your debt doesn't go up. Your cost of borrowing is going to be variable, right? Or you have a fixed rate. But that may go, like the cost of holding this debt may go up to like 7-8% if we see a hyperinflation. However, the debt that you have here now is equivalent to half because you're earning a lot more. Your rents have gone up. So you're in a severe cash flow positive situation if you weren't already. Your cost of borrowing does go up, but as a percentage, everything else has moved up. Your salary went up, the cost of goods went up, the rents went up, everything else went up except for your debt. So in conclusion of what I mean by all this is we are headed one way with interest rates. So if you are thinking interest rates are going to go up, possibly in a year, 2 years, 3 years, 5 years, 10 years, have a look at when our last increase was. It was 10 years ago, right? Have a look at other economies. Japan, they've pretty much been either decreasing or at negative interest rates already for a while. And so these things are going to happen because that's how the system changed. It's called modern monetary theory. And in effect, if you're able to acquire assets now quickly when cost of borrowing is so cheap and is going to get cheaper, people are going to find that their savings that are sitting in a bank account will remain dormant. They will have no value. They will not be growing. So people will pull it out from there and start putting into assets. As people become more aware of these things and just have a look at the media and how much is being spoken about negative interest rates now versus maybe 3 months ago. You didn't even know what negative interest rates were. You may be watching this and you still don't have an idea of what it is until you've seen this, but the idea is that interest rates will not go up. And if they do go up, it's only in one situation, which is hyperinflation. And as a property investor, I'm trying to get my hands on as much debt as possible because I can get today's debt and pay it off in tomorrow's dollar. So for argument's sake, if we were to go and buy a house in Sydney, right? If we bought a house in Sydney, say in 1995, and we bought a house for 100K, everyone would go, hey, you know what, 3-bedroom house for 100K in Marrickville, so in a city, inner west of Sydney, if I could buy a house for 100K, I wish I could have bought 4 of those, but everything was in line with it. So your wages, the average wage may have been $20,000 a year, right? Paddle pops were costing a lot less. Rice was costing a lot less, right? Bread was costing a lot less. So everything was in line with that. But let's say you bought this for 100K and your debt was 80K. So let's say 15 years later, you kept refinancing every 5 years and you went interest only, right? You decided, I'm not going to pay the principal down. I'm happy to keep my 80K as the debt and I'm just going to keep going through the cycle. So you kept it. Now, in 2020, is that not something that people earn a year, right? So when I'm talking about these concepts about what happens in the future, you may look at this video and go, oh, yeah, I don't think so. That's never going to happen. That can't happen. You better believe people in 1995, if they were told that their property that was worth 100K is going to be worth 1.5 million, 15 years later, or 25 years later, sorry, they would have told you you're an idiot as well. So guys, it's hard to understand why things are happening, especially in these short videos on YouTube. If you do want to have a bit more of an in-depth talk, you want to know what your situation specifically looks like and how you can benefit from what I consider will be the best period to buy property and get into real estate in the next 3 to 5 years, then please give me a call. We can make this happen. Get on a strategy session. It's free, so you're not losing anything apart from about an hour's worth of time, and you'll get an end-to-end blueprint strategy. There's a link in the description below. There's also links to my Instagram, my Facebook, and the website. Guys, get educated. Right now is the best time to be acquiring assets with the debt.